Hey TMFG community, John Iaconetti here with Carlo Cansino. In today's episode of Ask TMFG, we have Bob Dorrell joining us with part of a two-part series to take a look at how the interest rate markets are now playing an impact on the housing market and specifically mortgages. Remember, if you do enjoy this content, like, comment, and subscribe to the YouTube channel. We love doing these videos for you. Hey TMFG community, John Iaconetti here with Carlo Cansino. In today's episode of Ask TMFG, we're discussing current interest rates in our marketplace and how that's impacting mortgages across Canada. Today, we have Bob Dorrell with us from Dominion Lending in Whitby. And Bob, we're here to ask you the questions. What's currently going on right now with interest rates and the housing market?
Well, John and Carlo, it's great to be with you guys again. I hope you've got an hour because there's been a lot going on. I know we don't have an hour, so. But the last time we were together was in February of 2022. So that's only 6 months ago. And at that time, I think that was probably the peak month in terms of price increases. Looking back, prices in February were up 30% year over year. As we fast forward to the last stats that we have in July, prices are now up 10% year over year. And we've had 5 consecutive months of price declines. So June to July, prices were down 1.7. May to June, they were down 1.9, for example. So they are starting to come down. And why is that happening? Well, it's happening because interest rates have been on the rise since we last spoke, pretty steadily. And why is that happening? Well, it's happening because inflation has also been on the rise steadily. And the Bank of Canada is very emphatic that their number one objective is to keep inflation under control. They got a little bit behind the curve. And so they've been front end loading a lot of these interest rate increases to try to get a handle on inflation. We think inflation hopefully has peaked in June. I think it was over 8%, call it 8.1. We got a July print of 7.6. So that's the first time it's gone down. So that was good news and welcome news, of course, but there's still a long way to go. The target for the Bank of Canada is around 2%. So, when we spoke in February, the overnight rate, which is the rate that the government lends to banks, overnight, was 0.25%. Now it's 2.5%. The prime rate was 2.45% in February, and now it's 4.7. And the Government of Canada 5-year bond yield, which is how 5-year fixed rates are set, that was around 1.7. And now that today is around 3.15. A 5-year fixed rate back in February was, in the mid 2s to low 3s in terms of percent. Today it's in the mid 4s to the low to mid 5s. So the cost of borrowing money has gone up significantly. And as I said, the main reason for that is inflation. Because when prices get out of control, one of the tools that the government has in its back pocket is raise interest rates.
Right. And Bob, like you were saying, over the last 6 months, things have been wild. Rates have been increasing. Knowing all this information, obviously you don't have a crystal ball. We all don't have crystal balls. Where do we think things are going from here?
So in everything I've been reading, and there's lots to read on this topic, there's this very strong likelihood. So the Bank of Canada meets 8 times a year. The next meeting is in September. The consensus is they will increase the prime rate or the overnight rate by another 50 to 75 basis points. And from here to the end of the year, including that 50 to 75, the consensus is probably another 1% from here. So if the prime rate is 4.7, we're likely around 5.7 in terms of the prime rate at the end of the year. That's kind of what I talk to my clients about in terms of, if they want a variable rate mortgage, for example, what are the payments based on 4.7, but what are your payments if prime continues to go up to 5.7? If this is a baseball game, I'm going to say, we're probably in the 5th to 6th inning. There's sort of 3 phases that the government's going to go through here. We're in the tightening phase. And they're not done yet because inflation's still at 7.6, and they got to get that down. The next phase that we're all looking forward to is where they kind of pause, and that they're very data dependent, and they want to look at the inflation rate, what's happening to the economy. And you're not really going to see, I don't think, interest rate declines unless we start to see some serious economic deterioration, higher unemployment, those sorts of things. So that, we're going from this tightening cycle eventually to a pause. They're not going to continue to go up forever. They're going to pause at some point, likely, first quarter, maybe second quarter next year, and then watch the data. And at some point, hopefully they'll start coming back down again.
Awesome. Obviously, Bob, we said it before, we're not going to hold you to any of these thoughts that you have, but it's great to have the opinion of an expert. I don't know if John mentioned it earlier, but we do have Bob for another video. And in that video, what we'll do is, what we'll talk about is, what can we do practically speaking with the information that we have? For instance, if you have a mortgage that's coming up for renewal, what are the strategies that you can employ given this information? Or if you're looking to get into the real estate market, what are the things you should be thinking about? So that's for video number 2. Appreciate, Bob, your time for being here. Again, if you do like our content, please do subscribe to our YouTube channel. Give us some feedback, give us a comment on the videos, or if you like what we're doing, just give us a thumbs up or a like. Until next time, for Bob Dorrell, I'm Carlo Cansino.
I'm John Iaconetti.
And this has been Ask TMFG.